31st of October this year. And at the same time, Gaurang is very much a continuing part of the group. He has been appointed today at the board as the chairman of Kotak General Insurance Company, and he continues to be on the board of all our significant, many of our significant subsidiary companies, including Kotak Life Insurance, asset management business, alternate assets, as also our international subsidiaries. Therefore, all that is happening today is Gaurang is voluntarily deciding to step off from his whole-time role as the whole-time director in the bank, but continues to be deeply engaged and continuing with the group. So that is point number one. Point number two is Mr. Manian on my left. The board has decided to Manian's reappointment effective November 1, because his term gets over on 31st October, for a period of 3 years. And of course, that reappointment is subject to shareholder and regulatory approvals. So that is as far as Manian is concerned. Then Shanti on Gaurang's right. We are delighted to inform you that the board has decided to appoint Shanti Ekambram as a whole-time director, subject to shareholder and regulatory approvals, with effect from November 1, or whenever those shareholder and regulatory approvals come. And we are really delighted with Shanti's appointment. I still recollect the time going back into the late 80s when Shanti used to work. In those days, Kotak used to be an extremely small company. I would like to believe that we've got a lot of growth to get larger from where we are, but we were extremely small company in 1989, and I was just moving from a 200 square feet office space to a larger office space in Nariman Point. And I thought it was a huge office of 3,000 square feet. And I invited Shanti. She used to work in a global bank called Bank of Nova Scotia, and I still recollect that day when I invited Shanti over to see our big office to try and convince her that Kotak is a good place to join. And that is 1991. And we moved to that offices in 1989-90, Nariman Point, 3,000 square foot office from a 200 square foot office. And I had to convince Shanti to join us, and she finally joined in 1991. And I'm really delighted that Shanti is now coming onto the board of Kotak Mahindra Bank after a continuous journey across different aspects of Kotak. We became a bank only in 2003. So it's a significant journey that Shanti has traversed with the firm, and we are really delighted that she's now on the board of the bank. And in a way, whether it's Gaurang, whether it's Manian, Jaimin, Deepak and Shanti, the underlying philosophy, which I just believe, is that Kotak is a very strong sort of cadre of professional managers which has got together and worked over a long period of time. And I want to also share that the depth and the strength of the Kotak professional and a managerial franchise runs deep. And that's something which we want to also get your attention to. And this team is in many ways a continuing team in different aspects of holding the group together, and Gaurang continuing in a variety of areas is a part of that journey. And then Deepak Gupta is also being appointed, has been appointed today as the chairman of our subsidiary, which is Kotak Alternate Advisors, which is a large alternate asset management platform where we work in special situations and private equity and other funds. So Deepak will be chairing that. That is another announcement we have made today. And a third announcement which we have made is a colleague of mine called Mr. Kannan, who heads a commercial bank. He's taking charge as the chairman of our microfinance business correspondent subsidiary with effect from today. And that's all in the press release. And of course, this is also a part of our ongoing process of transition for Kotak as we go forward. And with that, as far as the financial results are concerned, I'll request my colleague, Jaimin Bhatt. Jaimin, many of you know, is this Group CFO. And Jaimin will take you through the numbers briefly. And after that, of course, we will open up for Q&A. And we can discuss whatever is on your minds in addition to what we want to first communicate with you before we open up the house. So over to you, Jaimin.
Thanks, Uday. We just announced our full year and quarter results for both bank and consolidated. So let me quickly take the consolidated numbers. We closed this quarter with consolidated profits of 3,892 crores, which is roughly about 50% higher than what we did in fourth quarter last year. If we take the full year at 12,089 crores, we're about 21% higher than what we did for the full year 21. But the bank contributes about 70-odd%, but the 30% number coming from subsidiaries, which continues to be at a pretty healthy number. Among the subsidiaries, Kotak Prime, with about 300 plus crores for the quarter, is about 60% higher than what it did in the same period last year. And similar numbers if you look at Prime for FY22 versus 21. The capital market subsidiaries had a very good year. And between Kotak Securities, Kotak Securities and Kotak Mahindra Capital, bringing in about 1,250 crores of post-tax profits, about 40% higher than what they did in FY21. The life insurance company, again, good fourth quarter at 267 crores, about 38% higher than what it did in quarter 4 last year. For the full year, there was a drag in quarter 1 when it took a hit on account of COVID claims. And therefore, for the year, the profits of insurance are lesser than what it did in FY21. As far as the assets which we manage across the group, we saw roughly about an 18% rise in the AUMs, which we closed at about 3,81,000 crores. With respect to the relationship values of what we advise, manage across the group, it's about 6.4 lakh crores, roughly about 67% higher than what it was a year ago. Our capital adequacy continues to be very strong at the console level. We are at 23% roughly at the tier 1 level. The ROAs, again, if I look at the quarter, it's a healthy 2.9%. If I take the full year, it's about 2.3%. Advances at the console level now at about 3 lakh crores. If I look at now the bank standalone, we did a post-tax profit for this quarter at 2,767 crores, roughly about 64% higher than what we did the same period last year. And for the year, we closed at about 8,570 crores, which is 23% higher than last year's full year. Our NIM healthy 4.78% for the quarter, and we did 4.62 for the full year. The NII growth for this quarter again has been 18% on a YOY basis. The asset quality continuing to be remaining very healthy. Our SMA2 numbers at 186 crores for the quarter. We've seen a dip on both the GNPA and the NNPA numbers. GNPA now at 234 and NNPA at 64. Our restructuring book again continues to be extremely small. If I look at my COVID restructuring, it's about 0.15% of the overall book, and the MSME at about 0.29%. Continuing to have a very good healthy CASA ratio at 60+%. We've also seen a pretty robust loan growth. While we had a quieter first quarter, we ended the year with a 21% growth on the advances, largely coming from areas like mortgages, including the unsecured, though on a smaller base. The whole agri pack continued to grow. The SME piece again grew. For this quarter alone, we showed a growth of 7.3%, not annualized for this period. So again, capital adequacy continuing to be very strong at the bank level. So the strength of the deposit growth as well as the advances growth continuing this period. Broadly, those were the highlights of what we did this year and this quarter.
I just want to add a couple of points to what Jaimin said, and then we will open up. So one is, if you look at our Q4, our slippages have been extremely controlled. So on an annualized basis, our slippages are about 1.08% on an annualized basis. Or in an absolute number, it was only, this is gross slippage, 736 crores. Therefore, it just, in a way, highlights the fact, at times we used to ask ourselves that, we were a little conservative, especially in the early phase of COVID. I think that our slippage ratios now actually demonstrate that the quality of our credit book is extremely robust as we exit COVID. So I think that's an important point. So at 1.08% is a very, very strong number. It shows that going forward on the historical book at least, quality of credit is in good shape. And the second important point I just wanted the media to recognize and focus on is, if you look at consolidated profits of Kotak Mahindra Bank, and let us assume that the consolidated profits are 100. 30% or more of our profits come from our subsidiaries. That means the bank itself is only, if you look at the 4 quarters, it's only between around 60 to 70% of the total profits. So consolidated profits contribute a very large part of Kotak's profits. And there are a variety of reasons for that. One of which, of course, is we own 100% of our subsidiaries. None of them are listed, whether it's the mutual fund, asset management company, whether it's our life insurance company, whether it's our securities company or our investment bank. So for the shareholder at the consolidated bank, they get advantage of 100% of the profits of these subsidiaries getting consolidated into the bank. As a result of which, our percentage of profits coming from non-bank are very significant compared to what is generally happens in banks. Same true for our NBFC subsidiaries, again owned 100% by the bank. So I wanted to highlight these 2 points to what Jaimin just shared with you. One being our slippage ratio is low and it reflects a very robust credit book. And second, consolidated profits are truly broad-based and not dependent disproportionately only on the bank. So with that, I will now open up for Q&A.
Thank you, Uday. One request, kindly ask 2 questions and then hand over this thing to somebody else.
Yes. Hello, sir. This is Ankur Mishra from ET Now. First of all, as you mentioned, sir, I will ask about the results only. And your NIMs have been quite healthy. You mentioned about 4.62%. But with RBI hiking rates now, what is your, how do you see NIMs in future, especially after 40 bips hike and CRR hike?
See, I want to actually share with you that our approach, if you look at our NIMs, we have always had high NIMs. And that's because, number one, our mix of retail is higher than wholesale in our total loan book. That helps in getting better NIMs. But these NIMs are high, also reflecting on a significant advantage on cost of funds. And when your CASA ratio is 60% plus, it has a significant positive impact on cost of funds. And we are entering into the new world of interest rates going up with a very high current and savings account ratio. Now, as you know, the rates on CASA do not change, or even on SA don't change as fast as regular deposit rates. Therefore, if 60% of my deposit base is CASA, that's a very stable cost of funds base. And I have always believed that low-cost and stable liability franchise is the core to sustainable banking.
So one question I would like to ask completely out of these results is on LIC IPO, which you are an advisor there and plus insurance company has invested there. How do you see faring of this IPO? What is your view on that, especially when you have also invested and after RBI has now hiked the rates?
You know, one of the most heartening things to me today was a kind of retail investor response which has come on the first day of the issue. That is extremely heartening. And I think LIC is a very strong brand in the minds of every investor. And I was just talking to somebody who was talking about the strength of the LIC brand. कि अगर किसी को insurance policy लेना है, they don't say कि हमें आप insurance ले लो. Many of them say आप LIC ले लो. So when you have such a strong brand and a national franchise of the scale and size of LIC, I'm actually very happy with the retail investor response which has come today. Yeah.
Thank you. Ritu, you are next.
Hi. One, when you say you're entering or sort of exiting COVID with a much better quality portfolio, will that conservative approach sort of change? And what is your outlook on asset quality? And secondly, with respect to the Reserve Bank of India's rate hike, what do you make of the timing coming today a few hours ahead of the rate hike, Fed expected rate hike, and also when we already knew what the March retail print was, when we already were expecting a higher print in April? Is this just to avoid, the reactive sort of tag, or what do you make of the action today?
Okay. So first, I will answer the first question first. If you look at our fourth quarter loan growth, it is about 29% plus annualized. That's 7.3% for the quarter, which on an annual basis is 29% plus. So we have got the accelerator on loan growth. And positively for us, bulk of our book is floating rate. Therefore, the ability to transmit interest rates as the central bank increases is very much inherent in our loan book. Therefore, we believe that our growth momentum on loans will continue, and we are very well risk managed, not only on credit quality, but also on asset liability matching, cost of funds, and our treasury book is at a very, very low duration of around 1.2 years. So we are getting into this period of high interest rates very well prepared as we go forward. Coming to your question on policy.
The timing of the rate hike, and also what that would mean for your lending rates going ahead.
Yeah, so on the timing of the rate hike, I'm sure some of you follow me on Twitter. So I've tweeted on Sunday, the wolf of inflation is firmly back. And the future is here and future is now. Obviously, I didn't know what RBI was going to do today, but it was pretty clear that the wolf of inflation is getting more entrenched. And therefore, there was clearly a need to move. And I compliment the RBI for having the courage to take this call between policies and during market hours. Because normally, if you go back to history of RBI policy, it has normally been after or not during market hours. So they've made it a point to have it during market hours. We've had intra-meeting moves, so that is also an important point, but during market hours. Therefore, I read this as a very strong message by the RBI that they're taking the point on inflation and inflationary expectations seriously, and you cannot allow the wolf to get deep in and then becomes that much tougher to get the wolf out.
Thank you, Uday. Saloni, you are next.
I want to refer to what Mr. Gupta had said when we were, starting the entire pandemic period. He said there were a lot of unknowns. So now that you're saying that you're exiting the pandemic, are we completely sure? You're writing back COVID provisions. So are we completely sure that that worry is over and behind us? Especially when we are moving in a higher interest rate scenario and we are still seeing that the bottom of the pyramid may not be out of the woods. You think that that is a worry factor? Also on the corporate book, we've seen across banks that, the corporate growth has remained tepid. We've seen 10% growth for your bank YOY. Going forward, do you see any indication of a capex revival? Are there inquiries coming in from your clients? What can you tell us?
Yeah. So I think a very good question. And if you look at in this period, our last year's annual report, the title of the annual report was Never Normal. So we are clearly in a never normal world. Therefore, first principle is, and something which is very much in our DNA as well, is never lower your guard. Okay? Therefore, even as you go for growth, always ensure that your antenna is open. So that is something which is very deep, and I believe that has to be there at all points of time.
Your numbers, a good set of numbers, better than what the markets were expecting, but also because there's been some provision right back. Are you, what sort of indication are you trying to give to the markets? Do you believe, some of the concerns relating to whether it was bad loans, COVID-related hit, even the current macro situation, how it's panning out? Are we in for better times ahead?
So, Ritu, first of all, we have to look at our data, and if you look at our slippage ratio, it's very much under control. We are at 1.08% slippage ratio. So with that level of slippage, which is now extremely well under control, we felt that we need to make provisions which are appropriate for the quality of our book. And that gives you a sense that we are very comfortable with the strength and the quality of our balance sheet. And that's where we come from. And as we go forward, I think in the early stage of the interest rate cycle, normally the credit side holds up. It's only if interest rates go out of control that it starts impacting the ultimate borrower. So I believe we are still in the early stage of the interest rate cycle upwards. And we do hope that the policymakers will try and nurture and protect growth even as they increase interest rates. So we feel we are in a very comfortable position from the point of view of the financial sector in general and from Kotak in particular.
So will that mean we'll see a much more aggressive Kotak Mahindra bank in the market, especially when it comes to the unsecured segment that you've deliberately stayed away from?
So in my last year's letter to shareholders, I'd mentioned that we are going to grow the unsecured retail book faster. If you've looked at our fourth quarter, we have grown at our consumer finance book by over 40% annualized. So we do feel comfortable. We believe that we have a very strong liability franchise, CASA ratio in excess of 60%. So low cost of funds, a very robust balance sheet. And we think we can now actually go and gain positioning in many parts of the lending segment, including unsecured retail.
And, with this now RBI action of a 40 basis point unexpected rate hike, what is your sense in terms of lending rates? How soon will we see banks pass them on? Because the limited portion is linked to the external benchmark. You still have MCR, repricing does take time.
Yeah. So, as you know, the entire book linked to repo rate gets repriced immediately. MCLR-based book had already started moving up. You had seen increase in rates which had happened in MCLRs in the last few months. So as the cost of funds goes up, it will be transmitted to the borrowers. And I think we got to be fair. Banks are basically converters. Therefore, our deposit rates will go up. So to that extent, savers will benefit.
Yeah, savers will benefit. But
so we have to look at this in a balanced way. There seems to be a tendency to look at it only from a borrower's point of view. The savers have been screaming for 2 years. My returns are gone. I'm in negative real returns. So I'm glad that savers will also be taken care of as we go forward.
But what do you make of the timing of the rate hike? I mean, inflation has been inching up. We do know the Fed was going to react. And RBI has been often, blamed for being behind the curve. Was today the right time to take this decision, especially when a huge IPO is opening?
So, I mean, I'm sure the RBI would have good reasons for what it has done, when it has done. I can just share that the wolf of inflation was here, and in fact, I have tweeted about it a few days ago. The wolf of inflation is here, and the time and the future is here, and the future is now. So, from the point of view of the reality, it is a fact that the inflation was getting more entrenched. Inflationary expectations were getting even more entrenched. Therefore, the time had come for us to recognize that.
Time had come for us to recognize that. Going forward from here, how many more rate hikes do you expect from the RBI? What is sort of the action going ahead?
So if you look at the RBI's estimate for next year in their April policy, they have estimated inflation at 5.1%. Therefore, for us to move to zero real interest rates, it means repo has to be at least 5%, okay, or 5.1%. Now that we are also doing numbers between 25 and 50 basis points as we have been. So at the least, to go to zero interest rates, if RBI's estimates of 5.1% Q4 hold, you're still talking about 5.1% repo. My view is inflation will be a little higher, and therefore, I would not be surprised if repo rates went to 5.25 or higher, depending on inflation, between now and end of March.
In this financial year, sorry, just one last question. How will this impact the demand for home loans? I know you say the decision will not be tinkered just because of a 40 basis point rate hike, but to some extent, do you see it blunting the demand, if not, slowing it down?
See, what has also happened on home loans, a lot of the inventory which was surplus has been utilized. Therefore, we are going to reach a situation where new inventory is not going to be that easily available. And input costs for the developers are also going up. Therefore, if you are a consumer, you will also ask the tough question. If absolute home prices are going up, you may be better off buying a home today than waiting for it, because the price may rise faster than the cost of your interest.
Okay, all right.
Thank you. Thank you.